Should be on the top, a switch right there.
Check. There we go.
Thank you. Okay. So because all the questions will be live fed, and we want to be sure that the question is asked correctly. No printed questions. So Mike will moderate. We'll start on one side and then the other. And you're certainly welcome to create a line so that you get the opportunity to ask your questions. So again, Mike O'Meara, I'm going to let Mike introduce Neel, but we appreciate partnering with them for another Economic Outlook Luncheon.
Thanks a lot, Bob. I think you can hear me. Is that right?
Yes.
Good. Well, I want to welcome you all. We've done this now for quite a few years, and we've had the opportunity to get some of the top talent actually in the nation from the Federal Reserve Bank, the Ninth Federal Reserve Bank in Minneapolis. You may recall Gary Stern, one of the past presidents, and Ariana Lakota, and this year we're very fortunate in having Neel Kashkari as our guest. And we're as I said, I'm very grateful to the Minneapolis Fed and the staff and all they've done to make it so smooth. Thanks so much. A little bit about Neel. You may have seen his resume, but a background that's perfect for today. Involved, of course, all the education, master's in mechanical engineering, and then an MBA from Wharton School of Business, and then the public and private experience with Goldman Sachs, except before that, I think rocket scientist would be the right word before he was at Goldman Sachs. And then at Goldman Sachs, of course, you may remember a guy named Henry Paulson, who was Secretary of Treasury, brought Neel with him to the Treasury during the depths of the recession. And then Neel got involved in the TARP, which he'll talk a little bit about today, the bailout of the big banks. And then after that, working with PIMCO, the biggest bond house in the nation, maybe the world, in California, and now with the Federal Reserve in the Twin Cities. So the format today is really, the goal is to engage you folks with Neel, and it's going to be strictly a question and answer format. And what I'd like to do is start it out to kind of get things going. We've got microphones on both sides. And so let me go to my notes here. Got a lot of them, but let's get started with the economy. We know that there's a lot of things on your mind, and we'll leave that up to you maybe as we go. But do you want a minute first, or?
Sure. Well, first of all, thank you, Mike, for hosting,
Sure.
And for the chamber, and for all of you taking time out of your busy schedules. Let me just start with a minute on why I'm here, why it's important that I'm here and that we're here listening to you and engaging with you. Most people don't know this. Some of you may know it, but a lot of people don't know that our central bank is unique. You know, 100 years ago, 1913 to be exact, when Congress decided that they needed to create a central bank for the United States, they said, we need a central bank, but we really don't like the idea of all this power concentrated in Washington, D.C. Other countries have had central banks for, like the Bank of England, hundreds of years. And then the U.S. economy had all of these financial crises in the late 1800s, and they said, we don't want that anymore. We need a central bank to smooth things out, but we really don't like all the power concentrated in Washington, D.C. So they compromised. And Congress in 1913 said, let's create a central bank, but let's make it distributed around the country so the power is not concentrated in Washington or New York. So they created the Board of Governors in Washington, D.C., and 12 regional Federal Reserve banks, including the Ninth Federal Reserve Bank, the Federal Reserve Bank of Minneapolis. That's why I'm here. That's why we're here. My job and my colleagues' jobs are to get to know our region of the country very well in terms of the economy, so that when I go back to Washington, D.C. 8 times a year for FOMC meetings, Federal Open Market Committee meetings, I'm able to speak with a lot of depth what's happening here in the local economy. So in many ways, I'm here to represent you. So the reason that we're here is to hear directly from you about what's happening, what's on your mind, what's happening in the local economy. It helps make us smarter and more insightful when I go back to Washington, D.C. And a lot of folks don't kind of have that background. So I think it's always important to start with that. And so the freer you are to speak up and share your mind, what you're seeing in the local economy, what your concerns are, what your outlook is, the more I'm going to be able to take away from you. And so I like to say to audiences, and I mean this, do me a favor and ask me your toughest question. Because if you've got a question on your mind, there's a good chance somebody else has the same question, and I'd much rather have you get it out there on the table and give me a chance to address it and learn from you than to have you leave wondering what it is or not speak up. I'd rather you speak up. And so that's why we're doing the format the way we're doing it. So thanks for that.
Sure enough. So let me start out with the first question, and then if you want to line up at the mics as you're asking your question, that'd be great. But the first one, how confident are you about the economy, and what are your expectations over the next several months? And do you have any special insights into western or northern Wisconsin?
Sure. Well, I think overall our outlook is for more of the same, what we've been experiencing, which is sluggish economic growth. I don't think any of us are happy that the economy's been growing as quickly as we would like. You know, coming out of the Great Recession, we expected a robust recovery, because the old rule of thumb for the U.S. economy was the deeper the recession, the stronger the recovery. Well, we had one of the deepest recessions in modern times with the Great Recession, and yet the recovery has been very, very slow. And that's kind of a conundrum. Why has it been so slow? And we can talk about some reasons why. Some of the reasons are demographics. The society is aging and not growing as quickly as it used to. Productivity is growing more slowly. There are a number of factors like that that appear to be continuing. And so right now, our best forecast is more of the same, sluggish growth, call it around 2% type of economic growth. Now, our region, the 9th district that we represent, is Minnesota, North and South Dakota, Montana, the upper part of Wisconsin, and the upper peninsula of Michigan. That's a pretty diverse economy. You've got healthcare, you've got ag, mining, manufacturing. It's a very diverse economy, and in many ways it reflects the U.S. economy. Overall, the 9th district, I think, is doing pretty well. It's not growing gangbusters. Some areas are doing a little better, some areas are doing a little bit worse, but it seems like more of the same is what I'm hearing when I go out across the district. And so, again, we're hopeful that the economy can grow more quickly, but right now we're not seeing big engines of growth, nor are we seeing big new headwinds introducing as well.
So questions from the audience?
We've got a shy audience today. Oh, we got a gentleman coming up.
We'll get them going here.
Thanks for coming. The last few years with QE1 and QE2, the Fed has got this massive balance sheet, unprecedented. What are the plans, or are there any plans to start ratcheting that down, or is this going to be the new normal, or will we grow it from here?
Sure. So the question, just make sure everybody heard, I'm not sure if the mic picked it all up, was the Fed expanded its balance sheet with what's called QE, quantitative easing 1 and 2. It's a multi-trillion-dollar balance sheet. Is that the new normal, or are there plans to bring that back down? We have announced plans that we do expect to gradually shrink the balance sheet as the economy allows us to start normalizing interest rates. So what we've said is our plans are, the Fed funds rate now is still very low. There's only been one rate hike, which was last December. That as that Fed funds rate starts coming back up, we would expect to allow that balance sheet to what's called roll off. Meaning the balance sheet today is made up predominantly of Treasury bonds, so bonds from the U.S. government, and Fannie and Freddie mortgages, by and large. As those bonds mature, right now what we're doing is we're maintaining the size of that balance sheet by reinvesting those proceeds to maintain the balance sheet. The first thing we said we would do is we'd start allowing it to shrink gradually on its own once we're underway in the normalization process. Let me back up for a second and explain why did the Fed buy all these bonds and buy all these mortgages. Typically, the way a central bank affects the economy is it moves short-term interest rates up and down. And so once you get short-term interest rates down to zero, then it seems that, well, maybe the central bank is out of bullets. There's nothing left to do. Well, when you buy a house or you invest in a factory, you're not just thinking about what's the interest rate overnight or for the next week or the next month. You're thinking, what is the interest rate? What are they going to be over the next 7 years, over the next 10 years? So part of the way monetary policy works is by driving short-term interest rates down, it actually affects longer-term interest rates as well. So once the Fed got down to zero on the short-term rates, by buying these long-term bonds, they started pushing down long-term interest rates directly. And that's another way of stimulating the economy. Again, if you're a business owner and you want to build a new factory, if you can borrow money for the next 10 years at a cheaper rate, it makes it cheaper for you to invest in that factory. So that's how quantitative easing works. And our view is once the economy gets stronger and we can remove some of this monetary stimulus, we will then allow that balance sheet to shrink back down to normal levels. So we do have plans to do that. We're just watching the economy. When will it allow us to do it? Thank you for your question. I know it's tough to be first. Got another gentleman coming up?
Excuse me. Yeah. Neel, you have been historically dovish. In fact, you were one of the 3 bankers to not recommend a discount rate recently. With Trump's promise to increase fiscal stimulus last night, does this change your dovish stance in any way?
Well, so we take fiscal policy. So let's just separate. Monetary policy is the Fed. We adjust interest rates to try to achieve the dual mandate that Congress has given us. So Congress has said, when they created the Federal Reserve, they said, and more recently, you have 2 goals, Federal Reserve. Goal number 1 are stable prices. Don't let inflation get out of control. And goal number 2 is maximum employment. And you've got monetary policy, interest rates, to try to achieve those 2 goals. Independent of that, the executive branch and Congress control fiscal policy. So spending on defense, healthcare, education, infrastructure, all of the, how much they tax you and I. Tax collection and spending, that's Congress and the executive branch. And that's the separation between monetary and fiscal policy. So we take fiscal policy as an input into our analysis of what's the appropriate stance of monetary policy. So whatever Congress decides to do, regardless of which party, regardless of who's president, that's an input into our analysis of the US economy. Just like this, if you think if the European economy grows very quickly, that'll have impact on the US economy. If China slows down, that'll have an impact on the US economy. That's out of our control, but we study it, we analyze it to say, what do we think it means for the US economy, and then what does it mean for monetary policy? So the bottom line is, we're going to have to wait and see ultimately what Congress and the executive branch decide to do. That'll be an input into our analysis, but it doesn't change the fact that we're going to look at stable prices and maximum employment. Those are the goals that we're trying to achieve, and we're going to look at all of this data to determine what's the optimal path for monetary policy to achieve it. Thank you.
Okay, I'll go third. Hello.
Hi there.
Sure.
I'm a local real estate agent, and so very much a student of the Great Recession. And even after reading Hank's book and Geithner's book and Bernanke's book, I still don't have a clear sense of why couldn't we have let Citibank or Wells or whoever, why couldn't we have let them fail? Because wouldn't some of our small local bankers who are here, in theory, been better off and get more customers if they would have failed?
Yep, it's a very good question. So going back now to the financial crisis, so I was appointed by President Bush, and I served under both President Bush and President Obama until we got through the financial crisis. And when I reflect on the decisions we made going into the crisis, the biggest mistakes we made, in my opinion, was that we were too ideologically in favor of just let the markets run their course. That was where my heart was. I called myself a free market ideologue when I went in. Just let the free markets work. And that meant that we were always late to how serious this crisis became. You know, in most of the economy, if a large company gets into trouble, you just put them into bankruptcy, their shareholders get hurt, maybe their bondholders get whacked, everybody else moves on. The problem is, in our financial system, with these giant banks at the center of it, they're like the heart and the arteries of our body, of our economy. And if you let them have a massive heart attack, it's not just the heart that suffers, it ends up being the whole body ends up getting hurt by it. So when we saw Lehman Brothers went through bankruptcy, and it led to chaos in financial markets, and it took a year or more for people even to figure out where the assets were and who owned what, and to try to put the pieces back together. So if we had allowed all the biggest banks to fail, it would have been truly devastating for the U.S. economy. I'll give you an analogy. I bet each of you understands that if we allow a nuclear reactor to melt down, it doesn't just hurt that nuclear reactor and that local area. It's devastating for the surrounding communities. So what do? We regulate the heck out of nuclear reactors to take their risk of failure down to zero. In many ways, I look at the biggest banks of America like nuclear reactors. Now, that's not saying that they don't have value, right? We do have nuclear reactors in our country. We haven't outlawed them. But boy, we've regulated the heck out of them to take that risk of a meltdown down to zero, or down to as close to zero as we can. And so that's where we were. We had these giant nuclear reactors at the center of our financial system. If we'd allowed them to melt down, it would have been Lehman times 5 or times 10. And instead of 10% unemployment, maybe we would have faced a Great Depression scenario of 25% unemployment. The bottom line is we don't want to get back there again. And so I'm sure we'll talk about it, but we've been working at the Minneapolis Fed on a plan to try to address this problem of too big to fail banks. Because in my opinion, the problem still exists, and the biggest banks have gotten bigger, and their advantages over the small and mid-sized banks have gotten bigger. So in some ways, the problem has gotten worse. And I don't think that's the right direction for us. Thanks for your question.
Neel, thank you for being here. My question is a little bit of a follow-up to that question. During your TARP administration, I have to say thank you for your administration of that. I believe you created a $10-12 billion profit, so on behalf of all the taxpayers, thank you. But your insight and your learning that came from that, what has changed or should change that will prevent that from happening again? Have we done anything at this point to prevent that?
Some good has been done. So I supported the fact that the Dodd-Frank Act was passed to try to reform banks and make them safer. So next week, we've been working on this plan for a whole year. We've convened the best experts from around the country and around the world who've come to Minneapolis to share their ideas. So coming out of the crisis, some people said, you know what, we should break up the banks, or we should treat them like nuclear reactors and regulate them that strongly. Others said, no, the economy's too fragile, don't do anything dramatic. And that was 2009, 2010. And so those transformational options were really taken off the table back then. And they said, let's keep the system the way it looks, and let's put some belt and suspenders and some Band-Aids around it, but let's keep it together. Well, I feel like now is the right time to step back and look, have we done what we needed to do, or should we do more? I think we should do more. So we've had this process all year where we've been consulting with the best experts in the world, hearing all of their ideas. And next week, a week from today, we're going to roll out our recommended plan to address too big to fail to the public. And then everybody can look at it and look for yourself. Have we done enough? Should we do more? And what are some options to potentially do more? And we'll have to see. You know, this is a little bit like terrorism. I'll give you, I'm using these like scary examples, but they're the best examples I can think of. So each of you understands intuitively we cannot make the risk of terrorism zero. It's impossible to eliminate all risk of terrorism. And you know intuitively that safety is not free. If we want more safety against terrorism, we're probably going to hire more law enforcement officers. Maybe we're going to have more metal detectors, maybe more screening. That costs money, right? There's an expense associated with that. So society has to decide how much safety we want and what price we're willing to pay for that safety. The same thing is true in financial stability. You all have to decide how much safety do we want against a future financial crisis and what you're willing to pay to achieve that safety. And what I want us to do is to lay out some options so that you, the public, can make informed decisions about that. Because ultimately, it's going to be your call.
Do you believe there is a correlation between low interest rates and investment asset valuations?
I do. I think that one of the mechanisms by which quantitative easing and low interest rates have affected the economy is that by driving down interest rates, it has likely pushed up asset prices, whether it's stock prices or real estate prices, et cetera. So in that sense, there's an inverse correlation, you could say.
Does that concern you?
It does. So one of the things that we look at is financial stability, right? We don't want to trigger another financial crisis. We're trying to get ourselves out of this last one. And if, in fact, we're creating new bubbles in other parts of the economy, we should be aware of that. And so some people say, that we have an explicit dual mandate, stable prices and monetary policy, but in many sense, we have a three-part mandate: stable prices, maximum employment, but also financial stability. And those things could be in tension with one another depending on what's happening in the economy. So we have a group at the Federal Reserve Board, a group of researchers who are, and across the whole system, that are looking at different parts of the economy, looking for financial stability risks. And it could be high asset prices somewhere. It could be a lot of leverage. We do look and try to take that into account.
Thank you.
Yeah, thanks for your question.
Somebody else over here had a question?
I have one here.
Yeah, over here.
The quantitative easing and all the bonds that you hold. I lived through the 80s with deregulation of rates. How does the government fare holding all long-term bonds at very low rates and short-term rates rising?
Well, I think, so right now, that's more of a fiscal policy question than it is a monetary policy question. So, and it gets complicated, but the bonds that get issued by the U.S. government, and whether they decide to issue long-term bonds or short-term bonds or medium-term bonds, that's all decided by the U.S. Treasury Department as part of their fiscal operation. And I think what Treasury is trying to do is they want to minimize the interest expense that the taxpayers have. And so they look at the interest rate environment and optimize the portfolio against that. So if interest rates then rise, you would expect borrowing costs across the economy to rise. So if you go and refinance your mortgage and interest rates are going up, you're probably going to pay more for your mortgage. If you go to get out a car loan, interest rates are going to go up, you're probably going to pay more for your car loan. Same thing is true for the U.S. government as they finance themselves. As the U.S. Treasury decides how to finance itself, interest rates will also affect the borrowing cost for the U.S. government as well. Now, right now, one advantage the U.S. has is all around the world, when investors get scared, let's say something's happening in Europe, they got scared about Brexit, or the Chinese economy is slowing down, they tend to run to U.S. Treasury bonds as a safe place to put their money. And so right now, borrowing costs for the U.S. government are very, very low. But if we can get the U.S. economy growing again, and the U.S. economy then drives interest rates higher because there's more investment, there's more growth, it'll be a good problem to have in a sense. A higher growth economy is going to be good for everybody, recognizing there will be some costs. It'll be more expensive for the U.S. government to fund itself. But if the U.S. economy is growing, then there's probably a pretty good chance the tax receipts will be higher too.
Hi, Neil. With yesterday's election, which nobody's mentioned, there's
Which
been
I appreciate very much,
yeah,
by the way.
I bet. There was a tendency within both the Freedom Caucus, parts of this Congress, and it looks like the next Congress, and the incoming administration to be opposed to the concept of the Fed itself, and certainly be opposed to Dodd-Frank. I liked what you said you're going to do to get out there and get the message of what the people locally want to hear and need to hear from the Fed. But do you have other ideas of what the Fed can do to be proactive in defending itself?
Sure. Thanks for your question. So, the Fed for decades, in my opinion, and not everybody agrees with me, but for decades, the Fed had this very, I call it the Wizard of Oz approach, which is they didn't communicate very much, and it was very secretive and very mysterious. And we didn't really build up a lot of trust with the people that way. And then when the crisis hit, boy, these are complicated topics, and we really needed the people to trust us, but we hadn't earned their trust. And so it led to a lot of anger and a lot of mistrust. So we're still trying to dig ourselves out of that hole. If you look at, true story, you look at independent opinion surveys of different government agencies, we're ranked lower than the IRS. It didn't used to be the case, okay? So let's start with a little humble pie that we have our work cut out for us. So that's part of why I'm here, right? I'm trying to do my part, and I know my colleagues across the system are all trying to do their parts. Get out across our communities in a very open and honest manner, make ourselves available to answer these questions and be accountable and explain our actions, and hope that we can earn some of that trust back. Because the thing is, The Fed is really a remarkable institution. If you all could see behind the walls, like the people that I see, we attract people who are committed to public service. We attract people who love their country. We attract people who are not there for politics, no political agenda, just do the right thing for our region and for our country. If we could show that to everybody, I think they'd be really proud of the institution. So we know we have a lot of work to do, but I don't think it's more mysterious than that. We just need to keep doing our jobs to the best of our ability, but be open and accessible and honest with people and let them see it. And I think we can earn that trust back again.
Hello, Neil. My name's Tom Gillette, and I'm a food distributor. But my question is broader than that. So with the Fed's technique of lowering interest rates and keeping interest rates artificially low, haven't we, in essence, funded the recovery on the backs of our population that has saved their money and put it away for not just a rainy day, but for their retirement when they have to move to interest-bearing instruments? But certainly they can't go into equities after that bloodbath we had in 7 and 8. So has the Fed really fulfilled their responsibility to our entire society, or have we just turned back on them?
Well, it's a very fair question, and that's one of the tough things that we have, which is Congress has given us this one tool, monetary policy, setting interest rates. But the tough part is this one tool is literally the bluntest instrument possible because it's one interest rate for the whole economy. So we can't segment it by region. We can't segment it by sector of the economy. We can't segment it by race or demographic or age cohort. It affects everybody. So that's why when we go out across the economy, we try to talk to as many people as we can, get a sense of what's happening at the economy as a whole, and do our best with this one number that affects everybody. And so you're right. There are trade-offs. There are winners and losers. And if in a low interest rate environment, that hurts savers, people who are trying to live off of their savings. We get it. But if the alternative is, well, let's just raise interest rates when the economy is growing slowly, maybe it helps the savers. But if the economy now grows even more slowly, I bet everybody is worse off than that. And so that's the tough thing. There's no easy answer that just says, you know what, we can snap our fingers, do this one thing, and get the economy moving again. I wish there were. We've been looking for it. We haven't seen it. And so we're doing the best we can given the limited choices that we have. And that's where we are and why we are where we are.
Good afternoon.
Good afternoon.
Fortunate to have you here today.
Thank you.
You see a lot of data. How far away are you from raising interest rates based on that data? Thank you.
Well, I'll tell you what I look at. How about that? By the way, I think I have a personal policy of not making forecasts about when we're going to raise rates because, we keep getting it wrong. And then everybody gets mad when, hey, the Fed said they're going to do it next month and then they don't do it. So my question is, why would we ever make these forecasts? It's who are we helping by making forecasts that might end up being wrong? So I try not to do that. But I'll tell you what I'm looking at. So one of the big surprises in the recovery, number one has been that it's been so slow. But number two, a lot more jobs have been created than we expected. And so a big debate in the economics profession is, what does maximum employment look like? Historically, before the financial crisis, you could look at the headline unemployment rate that gets a lot of attention and have a pretty good indicator that's how healthy the job market is. And right now, the headline unemployment rate is about 5%. And some economists think that's as low as it's going to go. But what surprised us over the past couple of years is it turns out there are all these other people who are not counted in that number who actually wanted to work. So the U.S. economy, because of population growth, we need to create something like 80 or 100,000, maybe 120,000 jobs a month to keep up with population growth. But over the last few years, we've been creating jobs a lot faster than that. 150, 180, maybe 200,000 jobs a month. So if we're creating jobs faster than the population is growing, you would expect to see that headline unemployment rate come down. But it hasn't been coming down because, in a sense, people have been staying in the labor force or re-entering the labor force that we didn't expect. So this is a long answer to your question. The bottom line is, how many people actually want to work is an open question. And so what am I looking at? I'm looking at, number one, where is inflation? Right now, for the last 4 years, we've been undershooting our inflation target. We have a target of 2%, and on our measurement, our core measurement, when you take out food and energy, which are very volatile, we're at around 1.7% today. So I'm looking for that 1.7% to move up towards 2. Number 2, I'm looking at inflation expectations. What do you think inflation is going to be doing in the future? Because that's a good indicator of where we think the economy is going. Those have been very low. And number 3, what happens to that headline rate? If we start seeing that headline rate drop quickly, then that should give us some confidence. There are a lot that we're kind of running out of people who are outside the labor force. So I'm sorry, it's a complicated answer to your question, but those are the 3 metrics I focus on: core inflation, inflation expectations, and headline unemployment rate, to give me some signal. Does this job market have room to run? Or are we running out and the job market's getting tight and we expect to see inflation around the corner? That's what's going to tell me when it's time to move and when it's time to raise rates. Thanks for your question.
Many economists say that for our standard of living to increase, we need GDP growth in the 3 to 4%, and that it's heavily dependent on productivity. And our productivity, frankly, has been dismal for the last decade. Do you see any improvement in that productivity, or do you have any comments regarding how can we improve productivity so we can get the GDP growth that what we need to make our nation thrive again?
Yeah, it's a great question, and you're spot on. So if you think about where does wealth, I don't mean richness, I mean wealth of a society, where does it really come from? It doesn't come from monetary policy. It comes from productivity growth. It comes from investing in our people so that our workforce is more skilled and more knowledgeable, and it comes from inventing new technologies that allow us to be more productive. We enjoyed very strong productivity growth, let's say in the 90s and in part of the 80s, but it's really slowed down since then. And if it doesn't pick back up, that's pretty ominous for us, because our economic growth is going to be slower than we've been used to. But it doesn't come from monetary policy. It comes from things like investing in our workforce and inventing new things. So there are policy measures that can help. So if government is funding basic research and development, as an example, I'm not talking about commercialization like Solyndra or picking winners and losers, but funding research at universities and at national labs to plant the seeds for future breakthroughs. That can help. If it's investing in our people so that more American young people get a world-class education, that can also improve our productivity. And then reforming some of our regulations that might be stifling growth. These are things that Congress and the executive branch can do that are out of control of the Fed, but they could make a difference in long-term productivity. But, they don't happen overnight. These are seeds and techniques that need to be planted early, and then they bear fruit, in many cases, years later. But we need to get going. It's very important.
Other questions? So let me ask you, Neel, on Too Big to Fail, was there any more that you were going to be able to talk to us about today versus a week from today when it goes public, or maybe to explain it a little bit?
Sure. Well, I think we covered the basics pretty well. The biggest question, and just to repeat a little bit, is you all have to decide how much safety you want. And the problem is with financial crises, human societies, we tend to repeat the same mistakes. Many of the mistakes that led to the Great Depression, we repeated leading up to the Great Recession of 2008. Now, it's not the same people, right? You and I are not going to make the exact same mistake. We've learned our lessons. The challenge is, are our children or our grandchildren or our great-grandchildren going to make the same mistakes? And so the question for all of us is, can we put in place a regulatory system that allows the economy to grow, that can flourish and thrive and be vibrant, but still put some boundaries on it so that 30 years from now or 50 years from now or 80 years from now, when everything looks rosy, we don't repeat the same mistakes, or the future generations don't repeat the same mistakes. I joke sometimes when I say this, but it's actually true. You can't legislate wisdom, right? It's not illegal to be stupid, to say it another way. And all of us, we all participated in a nationwide delusion that led to the crisis in 2008. And that delusion was that home prices only go up in America. And this delusion was shared by a lot of people, me too, right? I bought a house in California in 2005. I didn't see it coming, okay? But when you believe that home prices only go up, and all of the regulators and the rating agencies and the bankers and the home buyers all believe that, you end up making some bad investments. And it ends up being very painful when that ends up not being the case. So the question is, what's the next delusion that we're all going to participate in, or our kids or our grandkids? And so that's what we're trying to put our arms around. And I'm hoping that what we end up putting out next week is clear enough, it just lays it out there for you to understand and for you to then make some decisions about, hey, either you're comfortable with where we are, or no, we should do more. Ultimately, it's going to be the public's call.
Mike, first, thanks for hosting, and Neel, thanks for being here.
Thank you.
I guess maybe it's kind of a personal question, but you mentioned you bought a house in California in 2005, and I've read that when your job was done, I think in the Bush administration, you went to California and remodeled that house, and frankly, kind of hid in the woods for a while. What was your, and I don't know if that's exactly true.
It's pretty true.
But I wonder, would you just share with us, what was your mindset as you were going through that, and what was your take on the world at that point in time? As you look back now, how did you think things were going to come out?
Well,
and thank you.
Thank you. The financial crisis was terrible for the American people, and I'll be honest with you, it was terrible for us in the middle of it, because we felt that if we failed, we will be in the Great Depression. And so the good news was we had a team of people, totally non-political, just committed to doing whatever we could to try to keep the economy together. But we were working 18, 20 hours a day, some days overnight. I was sleeping in my office. This is basically 7 days a week, month after month after month. I remember in the worst moments of the crisis. So I bought this house in California in 2005. 2006, I got a chance to go to Treasury before the crisis. And I was paying my mortgage because my salary went way down when I left the private sector to go into government. So I was able to cover my mortgage out of my savings. There were a few moments in the crisis when I said, my savings was all in a money market account. When I said, oh my gosh, the money markets are toast. I'm going to lose my house. And I thought for a brief moment, I had to transfer my money from my money market account to my checking account because it's more likely to save. My checking account's more likely to survive. I really thought I was going to lose my house. Now, I didn't do that because I felt like I had an information edge over the public. And it wouldn't be right for me to take that action to protect myself when nobody else was in a position to do that. So I didn't do that. And I just figured, well, millions of other people are losing their homes, so now it'll be millions plus one more. And the worst moments in the crisis, I remember when we were trying to get the TARP up and running, there was one night an economist came into my office and she was sobbing. And she said, literally the financial system is collapsing beneath our feet. What are we going to do? And I said, all we can do, which is we have to focus on what we can control. We have to get our programs up and running as quickly as we can to the very best of our abilities. Hopefully that'll be enough. If it's not enough, we will figure out how to put the financial system back together the next day. And the best news was I was working for Treasury Secretary Paulson. He and then Fed Chairman Ben Bernanke, they were the right team, in my opinion, because their spirit was, we would rather try everything we can think of and fail in some of those than fail not trying everything. So they were pragmatic. There was none of this not invented here. We just said, bring the best ideas we can, put them on the table, and let's try everything. And by the grace of God, it worked. I don't want to pretend to you that we knew this was going to work. In the worst moments of the TARP, Congress authorized $700 billion for the TARP. In the worst moments, I tell you the truth, I did not think we would get a single dollar back. And now, 8 years later, we got all of it back. We made a profit off of the bank programs, et cetera. That's a miracle compared to what we expected at the time. And so again, I wish I could tell you we were brilliant. We were not brilliant. We were doing our best, and it happened to work. And I never want that to happen again for anybody else.
Yes.
Hi. First of all, I wanted to thank administration for inviting Financial Management Association from UW Eau Claire here. We're really honored to be present. And I had a question regarding, since you mentioned repeating the same mistakes, according to Wall Street Journal, after 2008, banks reduced their portion in mortgage loans from over 50 to 24%, if I'm not mistaken. And whereas non-banks increased now after third quarter to over 50%, but they are backed by the same banks. And considering low liquidity in that sector, do you think housing market can face the same issues that we faced in 2008? Thank you.
Sure. Well, if we look at, as I mentioned to the other gentleman, we look at asset prices around the country, home prices, we look at commercial real estate prices, we look at equity prices, trying to get a sense of, is there a lot of risk, is there a lack of safety in certain markets? And so when we look, for example, at home prices to rents, et cetera, we don't see the same kind of stresses and the same kind of buildup that we saw before 2008. Now, sometimes you don't see it coming until it's too late. Now, one thing that's different about the housing market now, and you may say this is not a good thing, it's open for discussion, is that Fannie and Freddie are providing most of the credit in the housing market today. And so it essentially, in many ways, the mortgage market has de facto been nationalized, which means that there's not the big risk of banks failing so much because of housing. The risk is being borne by the taxpayers in many cases. So that's a separate question. That's a separate set of risks. But I don't see the risk of the mortgage market bringing down the financial system the way we saw it in 2007, 2008. But I acknowledge there's a whole other set of risks that the public should have their eyes open to. Thank you.
I just have a question. The collapse in the stock market wasn't caused in 2007, 8, and 9 because stocks were too high. It was caused by the financial collapse. And I think the perception that I have and maybe others have is that the government's always a step behind, that the smart people, unlike you who chose to be a public servant, and thank you, but the smart people sometimes head to Wall Street and they do the securitization of things and they make up products all over the place. And I always think, how is it that the government can even understand what's going on Wall Street with when they're a little bit undermanned? And because you don't have a lot of the smart people who choose to do what you did and work for the government.
Yeah, it's really tough. And so we all have to be humble about our ability to see the future. So if you go back, coming out of the Great Depression, massive regulatory reforms were created in the wake of the Great Depression. So the Securities and Exchange Commission was created out of the Great Depression. Fannie Mae was created out of the Great Depression. Other regulatory bodies were created and reforms put in place. Back then, they never could have forecast what a mortgage-backed security was, or a structured investment vehicle, or a credit default swap, because these things didn't even exist. So there's no way whatever rules we come up with now are going to be able to work, given all the innovation that's going to take place in the US economy, except for one thing. The one thing we know that works and stands the test of time is equity, which is the buffer that banks have against losses, against the unknown. And the fact of the matter is the biggest banks in America had very small equity cushion. And when they faced losses that they didn't see coming, all of a sudden they were effectively insolvent. The losses exceeded the reserves that they had effectively set aside. So equity is actually a very powerful instrument against all of these new gee whiz products that they're going to invent, because those losses still come back to the bottom line and that equity. And so we're doing a lot of work looking at equity in banks, of the biggest banks, and do they have enough equity? And I think that's our best hope, to try to come up with regulatory reforms that can stand the test of time of this innovation, because we can never catch up. And by the way, the last thing I'll say, it's not just the government regulators who didn't understand the gee whiz bang products. Most of the folks on Wall Street inventing them also didn't understand the gee whiz bang products. It's just because they got a 7-figure bonus, they convinced themselves that they understood more than they knew.
So,
yes, all right. So following up on the last question and your response.
Can you come closer to the mic?
First of all, thank you for speaking today and being here in Eau Claire. Oh, you mentioned sort of the lessons that were forgot from the Great Depression back in the 30s, lead up to the 90s. It seems to me that one of the issues we're dealing with today is defining, the sort of equity side of the balance sheet. Is there any way to deal with defining what is a financial institution? Because isn't that one of the issues that we have? So we talk about shoring up sort of equity within lending institutions. How do we ensure that the regulation addresses all the entities that are engaged in the type of activities that we might call the financial industry in the aggregate? Is there anything sort of in plan to deal with that?
Yeah, so it's something we look at. So related to your question, some of the experts that came to us and presented their ideas said, well, if you really make the biggest banks safe, you're probably going to drive their costs up. And then what happens if that lending activity just moves to a hedge fund or moves to what's called a shadow bank? All these other things that are non-banks, but that sometimes do bank-like activities. And that's a legitimate concern, because if we just move all the risk from the biggest banks to some concentrated giant hedge funds, have we really improved safety? And so these are things that we are looking at and trying to understand how do we make sure that we address the risk wherever it lies. And so that is something that we are looking very carefully at and are very conscious of that possibility.
Many people think that the student loan crisis may be the next bubble. Can you give some comments on that, thoughts on that, and how the Fed might affect that?
Yeah, we do pay attention to it. It isn't obvious to me what the Fed's role is. I mean, again, as we adjust interest rates to try to manage our dual mandate, it affects all sorts of different types of borrowing. My understanding is a lot of the student loan market is now being borne by the taxpayers. So it goes back to my earlier comment about mortgage finance. Is it a risk for the banks? Is it a risk for the financial sector? Or is it a risk for the taxpayers? That's not to say that's not important, but it's a little bit outside the scope of the Fed, though we can monitor it as well. Now, one thing that does matter a lot, another thing that does matter a lot, is that students are finding it costly to get a college education. And so if we want to get productivity back up, making sure that higher education is affordable for students is clearly part of that, and that higher education is accessible. Again, a little bit outside the scope of monetary policy, but it is important in terms of long-term productivity growth to make sure that our workforce is equipped for the economy that we're living in. So we do pay attention to it, but I do think directly it's a little bit outside of the scope of what we're able to influence. But it's a fair question.
So I've got another question here, Neel. You've been on the job almost a year. As a new bank president, how would you describe your top priorities?
So my job I find my job very interesting, because the Minneapolis Fed has about 1,000 employees. And so part of my job is management, which I enjoy interacting with people, leading the organization. Part of it is developing public policy. So it's monetary policy, the work we're doing on bank regulation. I really am interested and care a great deal about public policy. And then part of my job is getting out in the community, just like I'm doing here today, and meeting with all of you and hearing from you what's on your mind. I also enjoy this part of my role, so I feel like the role is a very good fit for me. In terms of my priorities, I want to do all three of those things well, because I think that all three of those things are important. So I set a goal of getting out to every state within our 9th district in the first year, and this is the last stop in that first year, so I'm pleased to have done that. I also reach out to our elected representatives, regardless of party, across the 9th district, to build that dialogue, to make sure we hear from them what are top of mind for themselves as your representatives, what are their constituents telling them, and make sure we have that channel. I've been doing that very actively, and they've all been very appreciative of the outreach that we've done with them. And so those are some of my priorities, in addition to things like too big to fail, monetary policy. The other thing we haven't talked about yet that's a big priority for us is looking at disparity, economic disparity. And that could be racial disparity, it could be income inequality, it could be different geographies, just understanding what are some of the structural factors that lead to very different outcomes for people who may have the same educational background or may have different educational backgrounds. This is an area that needs a lot more research. I'll give you an anecdote. In America today, actually in America historically, no matter what the economy is like, generally speaking, black unemployment is always roughly twice white unemployment. So if it's a recession and white unemployment is 6, pretty darn good chance black unemployment is going to be 12. If it's a booming economy and white unemployment is 3, pretty darn good chance black unemployment is going to be 6. We don't know why that is. Part of it is education differences. We know that. But even if you adjust for education differences, so college-educated whites compared to college-educated blacks or Hispanics, there are big structural gaps. So it's really a concerning issue, and I'm even more concerned that we don't know why it is. And so we can't solve it if we can't even diagnose it. So one of the things that we are looking at across the Federal Reserve System is to use our research power to try to understand what these structural factors are. And we're just getting started. And so this is going to be part of a longer term work that we do. But I think it's very, very important that we do the work. It affects us here in the 9th District. You know, the Twin Cities has some very big disparities that I didn't expect to find until I got here. But it's also true all around the country. And so if we can better understand these issues, then hopefully we can come up with some solutions. And I think everybody would be better off if we could do that. So that's another priority for us, but it's a part of a longer term focus as well.
Great. Another question.
Yeah, I'm interested in your opinion on what are the critical factors or the critical issues that the next administration needs to tackle and needs to get right in order to keep the economy in the direction that it's headed.
Well, now you're asking me to weigh into fiscal policy and give advice to the new administration, which I'm loath to do. I'll say this, first of all, just set the obvious. So Congress has said to the Fed, we're going to leave you alone to set monetary policy and not interfere. And the quid pro quo is we're not going to get in their business. And so we work very hard to steer clear of anything in terms of partisan politics. So I'll just make, my comments will be generally speaking. It goes back to what we talked about earlier, which is how do we get productivity growth up? How do we make sure that the U.S. economy is as competitive as we possibly can make it? So we have a lot of factors that are creating headwinds for the U.S. economy that monetary policy can't solve. I'll give you an example, one thing we haven't talked about yet. We know that population growth is a big driver of economic growth. If you have more people, you have more consumers to buy cars, to buy food, to buy houses. You've got more workers as well. And the U.S. economy, our fertility rate used to be much higher than it is today. Fertility rates have gone down in developed economies all around the world. Well, if you do the math, that means we kind of have 3 choices. Number 1, we can accept slower growth. Number 2, we could try to subsidize getting more fertility, and that's things like child care policies and tax policies, et cetera. It's pretty expensive, but that's a choice we could make to get the fertility rate back up. Or number 3, we could embrace immigration more. That's math. And the public has to decide which of those 3 options you want to have. Nothing, that's not for the Fed, but that's for the public to ultimately decide because it has direct implications on long-term economic growth. And especially when you think about things like entitlements, you know, our entitlement programs are structured basically current workers pay for current retirees. As our population ages, that ratio gets out of balance. And so we definitely are going to need more young workers to fund some of those obligations. And so how do we pay for that? And so those are outside the scope of monetary policy, but those are important long-term issues for the Congress and the executive branch to ultimately come to some understanding about.
Okay, let's give Neel a great round of applause for being here today.
Thank you very much. I very much appreciate it.
Thanks a lot, man. Really nice job. Thank you.
And thank you to Mike Amira and People's Bank Midwest.
Thanks.
And enjoy the day. We're on a whole new adventure.
Thank you.
Hey, thanks, Bob. It was really great. Really appreciate it.